So today I am feeling pretty good and the market is dropping. Let me explain what I mean. So a lot of times people look at the market when they hear about, bearish markets, the markets are dropping, everything's going bad, right? People get really upset about it. People get worried about it, and understandably so, right? It means that there's less money invested in these companies, right? The companies are trading for less, their value goes down. There's a lot of times reasons behind that. But the thing is, the stock market dropping is not actually a bad thing. And in fact, I kind of get excited about it. Let me show you why. Okay, so hopefully here you can see the S&P 500, right? The general market index. And you can see today it dropped down. It dropped down about 200 points on the open today. Big move down from our high. We've dropped, show the other side of it. From the high to the low here today, we dropped, 9.77%. So almost a 10% drop here in the market. And the thing is, I'm really not upset about it, right? It's kind of cool actually because dropping market means cheaper prices for investments. So let me show you exactly what I mean. So right, let's say that I was going to go look at some investments, and I've got a couple of ones that I want to look through, but there's a couple that I just pulled up, but I want to show you guys what I mean by this. So let's say we were looking at buying WFC, Wells Fargo, right? We wanted to buy a couple shares of Wells Fargo. Let's say that we done all of our analysis, seen what the financial numbers look like, right, and decided that Wells Fargo is probably going to do well in the future, right? I really haven't looked at it. I'm not sure, but let's say we were looking at that, back here in the last few weeks, and we were saying, man, it looks pretty good. So I could buy it at $60 a share. It'd give me, a 40-cent dividend, give me 35-cent dividends back here, and you kind of figure out all your numbers. But you say I could buy it at $60. Let's say that I've got, 6 grand. Okay, I could buy 100 shares. Perfect. But what's cool is that if it drops down here to $50 or $52, fine, right? It's 14.21% lower, 14% lower than it was here a few days ago, which means that I can now buy the stock at a discount of 14%, right? Um, so that's why, like, man, the market dropping is actually kind of a cool thing because it can help you actually make better returns by getting better buy points on potential investments. Now, that said, right, if I had already bought in, now my shares would be trading lower, I'd be down. But in terms of investing, right, I always look at investing as a longer term game, right? I'm not in it for, the next 5 days. I'm in investments for the next 5 years, 10 years, 20 years, right? 40 years, whatever the case may be. So I look for companies that have good, strong fundamentals, and then I try to buy them at a discount when I can. And then I do some other cool things to try to cash flow them and help me get higher returns with them. Uh, but this is why the market dropping is a good thing. So let's look through a couple examples and I'll show you what I mean in detail, because it's kind of cool. So let's say we were looking at buying into Ford, right? Ford last week, right? Or I should say a couple weeks ago, this had an earnings announcement that dropped it too. So this one's a little more dramatic than others, but from 1485 down here to this 950, that's about a 36% drop, right? So that's a 36% discount if I think that Ford is a good one to invest in, and I think that it's underpriced, right? So kind of cool to see. The other interesting thing to look at here is sometimes, so normally I look at a 1 year daily chart. I could also look at 3 years weekly. So what that means is that if I click on it, yep, so now I'm looking at 3 years of price action, and every one of these candlesticks represents 1 week of time. So this is kind of cool. So we can see like Ford, has this little like long-term slow downtrend going on. It's getting close to the bottom of it. It's right by where these wick lows were at on the weekly before, right? This might be a spot. Now, I'm not saying that it will be, but just looking at the chart, right, it'd be important to look at fundamentals and do your homework on these. But just looking at the chart, right, this might be a spot where we get a move back up like this, or like this, or like this, right? This might be a spot where Ford wants to kind of climb back up. And if you were interested in buying Ford for the long term and you say, okay, yeah, I'm not that worried about, this downtrend that goes, it's a 20% drop or so in the last like 2.5 years. You say, well, I'm not that worried about it. I think Ford's a good, strong company because it's got, this PE ratio and this EBITDA and it's got all the stuff right. Then that means that you could get it at a discounted price here at, 949. And, maybe you think it'll come back up here to 14, maybe up here to like 18 in the future. Whatever the case may be. That's why it's super cool when the market drops. So let me show you a couple more examples and then I'll call it a day. But like, look at this. So Maine, this is one that pays a lot of dividends all the time. I don't actually even know exactly what this company is, but I got told about it by a family member of a family member. So kind of a cool one. But yeah, I mean, you can see, right, been uptrending. So if I were interested in buying it, up here at 52 bucks, now it's down here at 47. Hey, that's a 10% discount, right? Down here, 12% discount, all the way down at the bottom, almost 14% discount. So, right, you can see why the market moving down actually can be kind of a good thing and a blessing. The other interesting thing about it is, let's go to EPD. I want to find one that has a very specific look, right? I mean, this same deal. Actually, this one's kind of cool because, right, it's in this long-term uptrend on the weekly chart, right? You can see if I just extend this right, boom, right? It hits right where we're at. So this could be a spot where we get some upward momentum, right? Could be a good spot to buy. It looks like it might pay dividends, or it used to pay dividends, maybe not anymore. I haven't looked at a lot of these in a while, but it's like, hey, man, this could be a good buy point. And with the market dropping, that's a discount from $30 down to 27. That's a 7% discount, right? Still not bad. But I want to show you what's been downtrending. I don't know if this one has been. I want to show you kind of a downtrend, right? Same deal on this. Weekly, we're coming into a potential support area. Hey, maybe this is a good area to buy. Maybe not, but right, give some other analysis behind it. And this could be pretty powerful to see. When the market drops, there are good opportunities. Let's see. Okay, this would not be a terrible example. So this is Goodyear Tire, right? This one has dropped now down to 851, below its kind of lows of the last 3 years. But this is kind of interesting. So in the shorter term, let me switch back to a daily chart actually. But in the shorter term, right, you can see it's been downtrending. And let's say that I wanted to invest and I thought Goodyear Tire was great. Again, I don't know if Goodyear Tire is good. I haven't really looked at it. Certainly not dug into its fundamentals anywhere near close enough to now to be able to say whether it's a good investment or not. But it's like, okay, let's say I wanted to buy it and I started buying it back here, right? And I said, I don't know, every month I'm going to put in, I don't know, $100. And I'll just buy $100 worth of shares every month. So let's say I buy here, and then where's the next month? What is that? 15th. So then we go to 115, somewhere right here, and then we go to 215, right? And bear with me, I want to show you guys something that's kind of cool about this, that I've actually been able to use not on Goodyear Tire, but in my own trading or my own investing rather, to help me make better returns over time and to be able to lower my cost average. But this is super cool. What I'm basically showing you is called dollar cost averaging, where if you're in a stock and you want to buy it over the long term, a lot of people will just say, hey, just, put in a certain amount every month, and then you can do it. And that's really cool. But what's cool is that actually works sometimes even better on downtrends. So let's say I put in, $100 on the 15th of every month, right? It's not that much, but whatever. It's fine for this example. So at first I would have been buying it up here, and this is $15, right? My first buy point would be $15. So I'd have, I don't know, however many shares at $15. Then my next buy point was down here at, $13.30, right? Even maybe let's pretend it's down here at 13, right? So this is exactly what I want to say. So let's say we get in month 1 at $15, month 2 at 13, right? Month 1, 15, month 2, 13. What's super cool is that by the time you get into month 2, now you've got half of your shares at 15 and half of your shares at 13. And actually, because they're cheaper, you could even buy a few more shares at 13. So your average buy price will be $14. And then if you can actually buy more shares, it'll be even a little lower than $14. And that's called dollar cost averaging, where if the stock moves down over time, right, your average cost of entry gets lower and lower and lower over time. And it's a super, super cool thing to do when you're investing. I've used this in the past on a couple of stocks, and it's helped me make, better returns, get better average buy prices on things that in the long term, I think are going to do good, right? In the long term that I believe in, and that I've, got my plan, I've got my, parameters, whatever. But I think, okay, this is going to work over this period of time, and it's probably going to go up, to whatever price I think. But when the stock drops, like check this out. So month 3, right, we could get in at $12. Let's say we get in at $12. Now we're in once at 15, once at 13, once at 12. And every time we buy in lower and lower, it makes our average cost lower. So our average cost between those three would be $13, right? Heck of a lot better than 15. But what's wild is, or not 13, it'd be like 13.20. But what's interesting is the cool thing is as the stock price drops, you can buy more and more shares with the same amount of money. So if I'm putting in $100 a month, I can buy, oh, I don't know, let's do the math on that, right? 100 over 15, 15 is 6 shares. So I could buy 6 shares in month one, right? And then 100 over 13, I could buy 7 shares in month two. And then 100 over 12, I can buy 8 shares in month three. So I'm buying more and more shares as the stock drops, and I'm buying more shares at a lower price, meaning my average cost of entry drops, which is really cool. So the whole time that it goes down, that's great. Now let's pretend, for the sake of showing you guys how dollar cost averaging is really cool, that Goodyear tire is about to explode again. I have no idea, but let's pretend that in the next month it goes up here to $16. Highly unlikely, right? That seems wildly out of the range of what we would expect. But anyway, let's just pretend for a minute, right? And we bought all during this time. So let's say our average price was, oh, in here somewhere. Let's say our average price was like right in there, right? At let's say 1150, right? Where's 1150? Okay, we'll just put it right here. 1168. Let's pretend our average buy price over this period of time was $11.50 because we bought in every single month and we had more and more shares and all that, whatever. And then it goes up and we say, okay, 16 is, I think, as high as it's going to go for whatever reason. Again, I'm just kind of making numbers up. But let's say that that's where everything it's going to go. So it goes up there and we sell. That would give us a return of 37%, right? And this is what's cool. That's a 37% return. Keep that in mind. Versus if you had bought at $15, let me put my thing on $15 and then gone up to 16, that's a return of 6%, right? So that's a 31% increase in your return just by doing dollar cost averaging, where, hey, I think it's going to go up over time. I think it's got strong fundamentals, right? I've got good reasons to invest. As it's in a downtrend that I'm okay with holding through, let me just buy more and more and more, and I'll put the same amount in every month. And then my average price will drop so that when the stock goes up and I'm ready to sell, then my average profit, right, will be like a lot higher percent. And then I'll also have a lot more shares because I'm buying it over time. So anyway, dollar cost averaging, super, super cool. And one of the reasons, along with just getting a lower entry price, right? Like if I did want to buy this, right, $8.74. Let's pretend I thought it was going to go back to $12, right? That's still a 39% move, right? So that's a 39% discount from where I would have been buying it, 3 days ago, 4 days ago. So kind of cool to see that. And this one also had earnings too. So another one that's a little extended in terms of the size of the drop because of the earnings. And there's reasons for that, right? Like don't discount that there are reasons that that stocks drop from time to time, and it's good to know those. It's good to pay attention to those. When you're investing, it's good to make sure you're getting into good stocks that are going to give you good returns over time. But like when the stock market drops, it's kind of a cool thing. So I'm sitting here and I say, all right, this is the S&P, right? The S&P is dropping. It's coming up a little bit today. And honestly, I don't know where it's going to go from here. Right. I've heard speculation on both sides at this point. I think there's a good reason for it to drop if it wants to continue dropping, but it certainly doesn't have to, right? Certainly doesn't have to. So, but like if it were to drop, let's say we do drop to a full bear market, that's 20% drop, right? So let's say we get a 20% drop and we come down into here, right? That's a big drop. Now it probably won't happen that fast, but it certainly could. But let's say that we get our 20% drop and it's a bear market. And I say, wow, that's a big drop. Like, very interesting. But that means that like the overall market, I could get at a 20% discount. And a lot of stocks are gonna, move accordingly, right? You're gonna get stocks at a bigger discount. And what that means is that, when it goes back up to an uptrend, then, instead of holding all the way down, or instead of just holding for the loss, I can say, hey, you know what? I can buy in at a lower price. And if I'm already in, then I can dollar cost average. So my average price goes down. So my profits over time go up. Or, if I am paying attention and I were to, get out of stocks or hedge against drops in here somewhere, or, if it comes back up and drops, whatever the case, if you hedge and you protect yourself from some of those losses, and then you just buy back in, or, your hedge comes through and you can buy more shares, whatever the case, like there's a lot of cool things to be done that can actually help you make more money when the stock market is dropping, even looking at a longer term perspective, not just looking at day trading or doing swing trading, buying options, that sort of thing. So anyway, kind of cool. Wanted to talk about that for a minute, but yeah, when the stock market drops, it really isn't concerning. It's actually kind of a cool thing. Um, if you know how to position with it, and if you know how to do things like dollar cost averaging, and you realize that, you know, when stocks go down, that's when they're low, and you want to buy low and sell high, and that's how you make money in the market. So um, yeah, kind of cool. Wanted to hop on here and talk about that today. So hopefully that was helpful for somebody. And until next time, you guys, happy trading.